Navigating the Financial Landscape, Insights from Warren Buffett. Right now, the financial landscape feels like a high-stakes game of wait and see. Even the smartest investors are pausing, holding cash, or at worst, selling stocks like Apple in the billions. The market? It's looking like a bubble ready to burst. Stocks are overpriced, debt is soaring, and even Warren Buffett is stepping back. But what does Buffett see that we don't? And more importantly, should we be worried? Hi, I'm Finance Break, and today we're unpacking why top investors like Warren Buffett are taking cautious steps amidst warning signs of a potential market meltdown. I'll break down Buffett's concerns and, more importantly, what you can do to protect your financial future. First, let's talk about the elephant in the room, Buffett's massive cash pile. Berkshire Hathaway, Buffett's company, is sitting on a staggering $325 billion in cash. This isn't just a rainy day fund, it's a rainy decade fund. But why would one of the world's best investors hold so much cash instead of investing? Historically, Buffett has always kept cash as a safety net, waiting for the right opportunities. He did it during the dot-com bubble, sitting out the tech craze while others rushed in. Then, in 2008, when markets crashed, he used that cash to snag bargains while others panicked. Today, his cash reserves are at an all-time high. Buffett's actions suggest he sees a storm brewing on the horizon. Here's why Buffett is so cautious. First, high stock valuations. Buffett has openly said he's struggling to find reasonably priced investments right now. Then there's the Buffett indicator, a metric he uses to gauge market health. It's at 210%, the highest it's ever been. For context, during the dot-com bubble, it peaked at 140%. During the 2008 crash, it hit 110%. Today's levels, way beyond those, and that's not all. The US debt to GDP ratio is at 120%. In simple terms, the US owes more debt than it produces in a year. Combine that with rising interest rates, and you've got a recipe for slower growth, reduced corporate profits, and potential trouble for stocks. Let's break down Buffett's latest moves. One of the biggest surprises? He's been selling chunks of Apple stock, his largest and most successful investment. Buffett started investing in Apple in 2016, and it quickly grew to $178 billion. But over the last year, he's cut that position by more than a third. Why? High valuations, locking in profits while prices are high. Tax strategy, selling now avoids potentially higher capital gains taxes later. And it's not just Apple. Buffett has been trimming Bank of America and other holdings, while for 8 straight quarters, Berkshire Hathaway has been a net seller of stocks. This risk-off approach signals one thing: Buffett is preparing for a downturn, or at least waiting for better opportunities. So what does this mean for you? Here are 3 key takeaways from Buffett's strategy. 1. Patience pays off. When markets are overpriced, sometimes the smartest move is to wait for better opportunities. 2. Build a cash buffer. You don't need billions, but having cash reserves gives you the flexibility to buy when prices drop. Navigating the financial landscape, Insights from Warren Buffett. 3. Diversify your investments, spread your risk. A balanced portfolio ensures stability, even in turbulent times. Buffett isn't trying to time the market. He's preparing for what could happen. By staying cautious, building cash reserves, and diversifying, you can protect yourself from the risks ahead. Want to learn about the most undervalued stocks to watch right now? Click on the video on your screen. Like this video? Hit subscribe and stay ahead of the financial curve.